Welcome to Breaking Bread Presents Trading Basics. Thank you guys for joining me. Today we will be stripping down the charts to the basics. No hype, no indicators, no overloaders of the charts. We're just focusing on how to reprice, understanding what the chart is actually telling us, and we're going to build a solid foundation that everything else in trading sits on. For this first section, we're going to be discussing charts foundations. Buyers versus sellers. Trading consists of two groups of investors. We have our buyers and our sellers. Buyers believe that the asset will increase in value and seek to profit from that appreciation. We also call that going longs, taking calls, or a bull market. Sellers is your other participant in the market, and they believe that price will drop and seek to profit from that decline in price. We also call those going short, puts, or a bear market. Now, for each participant in the market with the buyers and sellers, we have a candle that represents both. So we have our uptrend candle and our downtrend candle. For our buyers candle, our longs candle, our call candle, our uptrend candle, this candle opens at the bottom of the body of the candle. It pushes to its lowest point. So this is the lowest price went with inside this candle before buyers stepped in and pushed price higher. Now we're starting to create this buyer. Price is getting higher. We're creating this body. We go to our highest point, meaning this is the highest price got within this candle before price came back down. It settled and closed at the top of the body. So we open at the bottom of the body with an uptrend candle. We're going to push to our lowest point first. So this is the lowest price got within this candle before buyers brought it up, creating this body. And we're going to go to our highest point, meaning this is the highest price got within this candle before we close at the top of the body. So we open, we go low, we go high, and then we close at the top of the body. Now for our downtrend candle, our shorts candle, our puts candle, our bear candle, we do the reverse. We're going to open at the top of the body. So this is our opening price for this candle. Price is going to push to its highest point. So this is the highest price got before starting to head to the downside. So we start heading to the downside. Price is selling off. Sellers don't like this price. They're saying price is too high, leaving this wick behind. Now we start creating this body. Price is getting lower, 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 and lower, and lower before we reach down here to the lows, meaning this is the lowest price has gotten before price is pushed back up by the buyers and closing at the bottom of the body. So you'll see with the downtrend candle versus the uptrend candle, the downtrend candle opens at the top of the body and closes at the bottom of the body, where your uptrend candle opens at the bottom of the body and it closes at the top of the body. So just going off of that information alone, you should be able to identify without looking at the color of the candle if it's a downtrend candle or an uptrend candle. How? Because if I look at the opening price and I see that we closed higher, then to go higher in price, we would have to go up, right? If we open at the top of the body and I see that the closing price closed lower than where we opened at, then that should suggest to you that this was a downtrend candle. So looking at this, and I just want to see if you guys are picking up what I'm putting down, so you guys can pause it if you want to, but we're going to go over it, right? So I have here the opening, high, low, close, and this is what you'll see on your chart if you're not looking at the candles, right? We have the opening, the high, the low, the close. If I focus on the opening price and the closing price, you should be able to identify, is this an uptrend candle or a downtrend candle? Is this a bullish candle or a bearish candle? So here we have an opening of $5.99 and we have a closing price of $6.02. So do you guys say this is an uptrend candle or a downtrend candle? You can pause it before I give the answer. All right, so if you said a bullish candle, if you said an uptrend candle, if you said calls, if you said longs, these are all correct answers. Why? Because if we're looking at this, this is saying that price opened at $599.68, right? It went to its lowest point of $597.23. before price got pushed up, started creating this body, and it went to its highest point of 602.95 before closing at the top of the body of 602.01. So remember, when the closing price is higher than the opening price, that's an uptrend candle. That means that price is heading to the upside. When the closing price is below the opening price, then that lets us know that that's bearish, that's downtrend, that's to the downside, that's your puts, right? That's your shorts. So good job if you got that correct. Now let's look at this one. We have an opening price of 249.38 and we have a closing price of 247.66. Go ahead and pause it before I get an answer. All right, so if you said that this was a bearish downtrend put candle, you would be correct. Why? Because the opening price is 249.38 and the closing price is 247.66. So that lets us know that the closing price is lower in price than where we opened. So we opened at 249.38. We went to our highest point of 249.69 before sellers stepped in and pushed price lower, creating this body. We went to our lowest point of 245.56 before buyers stepped in and like that price and bought it up. And we closed at the bottom of the body at 247.66. So closing price lower than the opening price, then we should be heading to the downside. All right, last one. Let's see. We have an opening price of 41.30 and we have a closing price of 41.59. Go ahead and pause it before I give the answer. All right, so if you said uptrend, if you said bullish, if you said longs, um, if you said to the upside, then you would be correct, right? This is a buyer's candle. This is telling us that price opened at 4130.90. It went to its lowest point of 4125.90. It pushed to its highest point of 4168.40 before closing at the top of the body at 4159.30. So the closing price is higher in price than where we opened. So that is an uptrend candle. So good job if you got those all correct. If you didn't, it's okay, right? We're all beginners. We're learning. We're learning together. All right, so let's move forward. Let's talk about who's in control and the types of candles that you may see within trading. So let's go over the buyer side of trading, and then we're going to go over the seller side of trading. So when you see a full body candle like such and you don't have any wick at the top or the bottom, this is letting you know that buyers is truly in control. They're in full control. Sellers aren't putting up any fight. It should continue in the upside direction, right? Here, same thing, right? Strong body candle. Now you do have wicks at the top and the bottom, which lets you know that there was a fight, right? That's the damage that was put in. But the body is letting us know that buyers is definitely still in control. Now here you see this long wick and you see a small body. This is letting us know that sellers tried, right? They got active, right? But buyers still held on. They still held on. So, but the body is letting us know that they tried in that wick. They tried in that wick, but the body is letting us know that they held on. In this situation where the wick is at the top of the bodies, same thing. Sellers are fighting, but buyers are getting weaker, right? When that wick is at the top, that's letting us know that buyers are getting weaker. Wick at the top, body at the bottom. It's a fight. Buyers are holding on, but they're getting weaker. Versus this candle here, where sellers were active, but the wick is at the bottom and the body is at the top of the candle, towards the top of the candle. That lets us know that buyers have strength, right? And how these candles are formed, let's just go over that real quick. So we open at the bottom of the body here. And when we open, we push to our lowest point. So if we're ever heading to the downside, that's a red candle. That's a downtrend candle, right? So just from this opening to this low, just imagine that this being a red candle. Before buyers stepped in, it said, oh, that is a great price. Let me buy that up. Bought it up, bought it up. So as it's buying is up, it's leaving that wick behind, right? And then we go to our highest point and then we close at the top of the body. So it was a fight in between this wick between the sellers and the buyers, but buyers said, nah, we got it, right? And we close at the top of the body. Versus this candle here, right? We open at the bottom of the body, we push to our lowest point, right? So just from this open to the low of this wick, buyers tried it, right? Pushed up. Buyers pushed it all the way up to this highest point, and then sellers stepped in and said, nah, too high. Sold it off, 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 sold it off. And then we closed at the bottom, I'm sorry, at the top of the body here, right? So we still close as an uptrend candle, but sellers was trying to fight to push this back the opposite direction. But the buyers held on there. Now your doji candle, that's your indecision candles. There's no winners within that candle, right? No buyers or sellers are winning. It's pretty much a split decision, right? But same thing. We open at the bottom of the body. We push to the lowest point. We get to the top here where we put in the high. Seller stepped in, right? And we close at the top of the body. So real thin body, long wick. Wicks are longer than the bodies, right? So that's your doji candle. No clear winners, your indecision candles. Now, for your seller side of trading, pretty much the same thing, but just the reverse, right? We see a full-on body candle like this, that's letting us know that sellers is definitely in control, right? We don't have a wick at the bottom, no wick at the, a wick at the bottom, no wick at the top. So your sellers are definitely in full control here. In this candle here, we do got a wick at the top and we got a wick at the bottom, right? But we open at the top of a red candle. We pushed to our highest point before a seller stepped in and said, nope, too high, sold it off, sold it off, sold it off, sold it off. We get to these lows, right? And buyers say, oh, that's a great price. And they tried to push it up, but they fell short before this candle closed. So full strong body, downtrend candle, letting you know that sellers is definitely in control. This candle here is telling you buyers were active, but sellers was just a little bit stronger, right? So we open at the top of the body, we push to the highest point. So just envision from this open to the highest of this point of this wick that this was a full green candle before a seller stepped in and said, nope, that's too high of a price. Let's sell that off. Selling it off, selling it off. As we're selling it off, we're starting to leave that wick behind. Starting to leave wick behind, leaving wick behind, right? The price get down here to our lowest point, and then we pull back up by the buyers, got pushed back up by the buyers just a little bit, not too much there. And then we close at the bottom of the body, right? Still a downtrend candle, but it's letting us know that buyers tried, right? They tried, but failed. They tried but failed. So sellers are definitely more active in this candle. With this one here, same thing. Buyers are fighting, but sellers showed that they are getting weak, right? Because we open at the top of the body, all right? We push to our highest point, and then we start selling off. So imagine this being a full-on red candle, kind of like this one here, right? Before a seller stepped in, I'm sorry, before a buyer stepped in at these lows and said this was a great price and bought it up. And as they're buying it up, it's leaving that wick behind, right? And then we close at the bottom of the body. So buyers tried, but it's showing the weakness that they're trying, like they're here to fight, right? They're here to fight, especially if you envision this as a full red candle, which it was, and that wick behind is letting you know that buyers tried, but fell just a little short in strength here, right? So still sellers are here, but buyers are fighting it. And then your last candle here is your doji candle, which as I said is your indecision candle. No clear winner of sellers or buyers in control. So these are the candles you want to stay away from. This shows exhaustion. So be mindful of that. All right, that's session one of this class. I thank you guys for breaking bread with me. See you in part two. Welcome to section two, where we're going to talk about price movement and time frames. So when we come into the day and we're looking at our charts, we need to understand that price moves from left to right. So it's going to start from the left and it's just going to keep moving to the right of the chart. And that's how price moves, right? So when we're looking at any candles on the charts, we're going to have our previous candle, and we're going to have our live candle. And once this live candle closes, right, we talked about that in section 1 where we talked about where the candle open, high, lows, close. When this candle closes, this next candle that opens will become the live candle, and then this one will become the previous candle. Let's take a look at this and see how price moves within this candle. You see, this is our live candle, and this is our previous candle. So we'll see how price moves. This candle is now closed. So now this is our previous candle, and this is our live candle here. And you'll see in each candle to where you'll see it go red, green, right? That's that fight that I was talking about in the first section. And you see how price is dropping to the downside, right? Red candle, we're moving to the downside. Price is moving to the downside. We opened here, right? So now this is our previous candle, and now this is our live candle. And you can see how that candle went from red to green, right? So this is how price moves. We're looking from price from the left, and we're going to start moving to the right of the screen. Good price moving in that candle, right? So now this becomes our previous candle, and this is our live candle. So it's going to move from left to right. Now let's talk about time frames. So depending on what time frame you are on, that's what that candle represents. So we have our higher time frames, which that's what the HTF stands for, and we have our lower time frames, LTF, right? So if I was on a yearly chart and I'm looking at the candles from left to right, a yearly chart means that each one of these candles represent a year of price data, right? So let's just say this was 2021. Then this next year candle here will be all the information from 2022. And this will be all the information from 2023. And this will be all the information from 2024, right? If I was looking at the monthly candle, let's just say this was January. This would be February. This would be March. This would be April, right? That's what that means. Each candle, depending on whatever time frame you're on, the candle is going to represent whatever that time frame is. So if I was on the daily time frame, let's say this was Monday, this is Tuesday, this is Wednesday, this is Thursday. So that candle, that full candle represents that time frame. It's the same thing if I was on the lower time frame. So let's just say this was the 5-minute time frame. Well, the market opens at 9:30. So this would be from 9:30 to 9:35, 5 minutes of information. This would be from 9:35 to 9:40, right? 5 minutes of information. This next candle would be from 9:40 to 9:45, and then so forth, right? 9:45 to 9:50. That's how that would go. If I was on a 1-minute time frame, market opens at 9:30. Well, this candle would close at 9:31. This candle would close at 9:32, 9:33, 9:34, right? So it just depends on what time frame you are on, right? Doesn't matter the direction of the candle, right? Whatever time frame you on, each candle is going to represent whatever time frame you are on. All right, so let's break it down just a little bit further because what's happening on one time frame is happening on all the time frames, right? But the lower the time frame is the more detailed of the picture. The higher the time frame, your clearer picture, right? So if I was on the hour time frame, right? I'm gonna start at the higher time frame and we're just gonna compare it to the lower time frames. You can see on this hour time frame, and we're just going to pay attention to the white candle here, which is a downtrend candle. It's outlined in red, but it's your downtrend candle. That's where we're going to focus on, right? So if I go to the hour and I look at this candle here and I say, okay, well, what happened within that hour time frame? I can drop down to the 15-minute and see a more detailed picture. So it takes 4 15-minute candles to equal 60 minutes. So this candle, this candle, this candle, this candle is what represents this 1 hour candle here. So this is 15 minutes of information. This is 15 minutes of information. This is 15 minutes of information. And this is 15 minutes of information. So this candle opens here, right? Opens here. And within this one candle, all of this happened here, right? Well, let's say I want a more detailed view of it. All right, we can go to a smaller time frame. So if I go to the 5 minute time frame, I understand that it takes 12 5 minute candles to equal 60 minutes of information, right? This is our hour. So these 12 candles here is what's represented in this one candle here. But let's say I wanted to focus on this first 15-minute candle as well. Well, if I wanted to look at this first 15-minute candle here, I know it takes 3 5 minute candles to equal 15 minutes. So 5, 10, 15. So these three candles here is a representation of this candle here. 5, 10, 15, that is a representation of this candle here, and so forth, right? And this is just a more detailed picture of what the higher time frame is saying. Remember, the higher the time frame, the clearer the picture. The lower you go, the noisier the picture is going to get, right? But sometimes you have to go to the lower time frames to see the more detailed picture. But the higher time frame is going to be your friend. The lower time frame is going to be your friend. So don't think what's happening on one time frame is not happening on another time frame. No. On this hour time frame, whatever the 15 is doing, you're going to see that same movement on his hour time frame. Whatever the 5 minute is doing, you're going to see the same movement on the higher time frame. Now, it's not going to be as quick as movement because it's just a calmer picture on the higher time frame. But understand, it's moving from left to right. It's moving from left to right, and it's going to be a clearer picture at the top on the higher time frame. All right, we've come to the end of lesson number 2. Thank you guys for breaking bread with me. I'll see you in section number 3. Welcome to section 3, market structure. Now understand that price can only do one of three things. It can either go to the upside, which we call an uptrend, or it can head to the downside, which we call a downtrend, or it can consolidate or range. So let's talk about what consolidation and range means. So when we say price is in a range, we're saying that price is moving sideways between a clear high and clear low without breaking out in either direction. So what that could look like is what you see here, right? We're going to look from price, like I said in the last class, we look at price from left to right, right? So we look at this situation here to where price put in a clear high, it put in a clear low, but it's not breaking above or below that area, meaning it's not closing outside this area and it's not closing outside these lows here that's represented by this wick, right? It's kind of like playing between the white lines that we have here, right? It's like bouncing, rejecting back and forth, right? Just bouncing back and forth, right? And if you look kind of to the left, I'm sorry, to the right, you'll see it's kind of like in a straight line. It's not really going anywhere to where you see like a full-on move like this or a full-on move like this. It's just pretty much staying in the same range. It's staying in consolidation. It's not telling you buyers are winning and it's not telling you that sellers are winning, right? That's what we mean when I say price is in a range. Same thing down here, right? This range is a little wider, but we're clearly not getting above this area right now, and we're not getting below this area here, right? So we come into this area, we're bouncing. We're getting to this area, we're rejecting back down. We get into this area, we're bouncing. We get back to this area, we're rejecting back down, right? So we're not clearly breaking a way out until here, yes. But right here in this moment where price was at, it was not breaking out and giving us a clear direction of who's in control, buyers or sellers, right? Same thing here, right? Price is not getting above, it's not getting below. If we look to the right, it's kind of looking like a straight line. but we're playing in between the white lines here, right? It's not telling you yes, buyers, not telling you yes, sellers, right? No clear direction. That's range, that's consolidation, and that's where we want to avoid trading at. Now let's talk about what an uptrend is. So your uptrend, your bullish leg, your bullish price action, this is price going up. So if we are in a uptrend, our highs should be getting higher and our lows should be getting higher. So we have a low put in, meaning this is the lowest price got within this trend. Price gets to its highest point, right? So now we put in a high. Now we put in a higher low, meaning that this price here is higher in price than the original low that was put in. And then we go put in a higher high, meaning that this high is higher in the price than the last high that was put in, right? And we just keep doing that in a uptrend. Our highs have to get higher in price. That's the only way we can go up if price gets higher, right? But our lows have to follow as well, right? So our lows have to be lower, and I'm sorry, higher in price as well. So this low is higher in price than this low, right? This low is higher in price than this low, and so forth. So on a real chart here, you see that a low was put in, it started making its way up, right? We put in a high, we came back down, we put in a higher low, meaning that this highs is higher than the lows that was put down here. Then price pushed back up. We put in a new high. So that's a higher high. That's what the HH stands for, higher high, right? So that's telling us that this high or these highs is higher in price than the highs that was put in here. Price pulled on back, put in a higher low, meaning that this low is higher in price than this low, and then price breaks out and creates another high, right? So this high is higher in price than this high. It's higher in price than this high, right? And the lows are getting higher as well, just like the diagram that I showed you here. So we are in an uptrend when we can keep making these highs, right? We got to keep making these highs, meaning we got to keep closing higher. As long as we're closing higher, we are in a uptrend. As long as our lows are getting higher, there's no way possible to make new highs without making new lows. So as long as we are in the uptrend, the lows will follow and be higher, right? They will follow as long as we're in the uptrend. Now your downtrend, your bearish leg, your bearish price action, your sellers are in control, right? So when we're looking for a downtrend, it's the reverse. Our highs should be getting lower and our lows should be getting lower, right? So we put in a high, we go ahead and put this low in. We go put in a lower high. We break through that low, meaning we got lower in price than the last low that was put in, right? So that lets us know, okay, well, price is heading to the downside, right? We go put in a lower high. We break through the last low, meaning it's closing lower in price than the last low that was put in. We pull back, we put in a lower high, and then we break through and take out the lows there, right? So our lows are getting lower in price because that's the only way we can head to the downside is if our lows are getting lower in price and our highs are getting lower um, in price, right? So if we look at the chart here, we see that highs was put in. We went to go put in some lows. And then we came up and we went and put in a lower high. So these highs is lower than the highs here, right? So if we look at these candles here, right? It's all one area that's lower in price than the highs here. The moment price closes below the last low that was put in, right? Then we are at a lower low. That's what we want to do. Price pulls back. It makes a lower high. It breaks through the last low that was put in. So that lets us know that price is getting lower in price. So let's see if you're picking up what I'm putting down, right? So you're going to pause it. I'm going to show you an image. You go ahead, pause it, answer it, and then I'll give you the answer after I present the image to you. So looking at this image, I just need you to identify who's in control. Is it buyers or sellers? Are the highs getting higher? Are the lows getting lower? What is price doing in this image? Pause it and figure that out for me. All right, so if you said buyers are in control, you would be correct, right? Not only obvious because price is moving to the upside, we got all these green candles, right? But if we're looking at price, we put in a low, we put in some highs, we put in a higher low. So our lows are getting higher. This low is higher in price than this low. Price go ahead and made a new high. So this high is higher in price than this high. So if the highs are getting higher and the lows are getting higher, it's all only right to say buyers are in control. We are in a uptrend. All right, let's look at this next one. Who's in control? Buyers or sellers? Go ahead and pause it and let me know. All right, if you said sellers are in control, you would be correct. Why are sellers in control? Well, let's look at it. We have a high. We put in a low. We put in a lower high, right? So this high is lower in price than this high. We put in a lower low. Well, the lows are getting lower in price, right? Then we come and we put in a lower high. Okay, now the highs are getting lower, meaning prices going to the downside, and the lows are getting lower as well. So we are definitely in a downtrend. I know it's kind of obvious. Well, it's all these red candles. Yeah, I know. But we got to look at market structure, right? Market structure is what's telling us what we're in. A downtrend, uptrend, or are we consolidating? So good job if you said sellers there. All right, so let's talk about reversals and pullbacks. So a reversal is a complete change in trend, right? I said price can only do one of three things. It can go up to the upside, uptrend, and to the downside is a downtrend and consolidate. So a full-on reversal is a trend, is a change in trend direction, right? It signals a shift from bullish to bearish or vice versa, vice versa. It's confirmed sometimes by price action taking out a starting point of the opposite trend, whereas your pullback is a temporary change of direction within an existing trend. This is often seen as a short-term dip before continuation. So your reversal indicate trend shifts while your pullbacks are short-lived correction within a trend. So the image that I showed you guys earlier, where price put in the low, it put in that high. The temporary trend direction is what we call our pullbacks, right? The market is always has to correct itself. It always has to correct itself. Pullbacks are a part of trading. So lows, high, we pull back. We were in an uptrend. Now we're in a temporary downtrend. We have to go in that temporary downtrend to go put in that higher low, right? Then we start making our way back up. And then we got to pull back because we have to correct ourselves. We have to go in the temporary trend direction. Temporary trend direction is to the downside if we are in an uptrend. So looking at the images here, this here is your downtrend. This is your pullback. That's your temporary trend direction. This here is your temporary trend direction, right? We have to go put in those higher lows for us to make our way back to the upside. Now down to the downside is just the reverse, right? If we're headed to the downside, our temporary trend change would be the opposite of a downtrend. So the opposite of a downtrend is to the upside. So if we put in a high and we go put in a low, where we're heading to the downside. So our opposite trend change would be to the upside. So we're going to pull back to the upside because we have to go put in that lower high, right? Same thing. We break through. We go put in the lower low. Okay, well, we got to go put in the lower high eventually. And it does, right? And then we break down. And then we got to pull back and go put in the lower high. As long as we're in the downtrend, we're going to have to pull back to go put in those lower highs. Same thing here on the chart, right? This is a pullback. All this here is a pullback. Price drops down. This here is our temporary trend change, right? Heading to the upside. And then we break back down to the downside. Those are your pullbacks. Now your reversals is your full on, we're not going to the upside anymore. We're heading to the downside, or we're not going to the downside anymore. We're heading to the upside. Now it's easily identifiable when it takes out the starting point of the trend. So here we were in an uptrend. Price started to consolidate, range, and then we started to break down, right? The moment price gets past this starting point here, we are now in a downtrend. So we should not even be thinking price is heading to the upside. when price does that in this situation. Here, same thing, right? We started here with the downtrend. We're making our way down. And then price breaks above where our starting point happened for our downtrend, right? When price does that, that's a full on reversal, right? And we should be looking for price to continue heading to the upside versus this original trend, which was to the downside. All right, so let's see if you're picking up what I'm putting down. I'm gonna show you two images. You tell me which one is the reversal, which one is the pullback, or are they both reversals, both pullbacks? You tell me. All right, so we got A, we got B. Go ahead and pause it before I get to the answer. All right, so let's look at it. If you said reversal for A and pullback for B, you would be correct. Why? Okay, so we had an uptrend starting here. So once price gets past our starting point, we should be heading to the downside. So that is a trend reversal. We went to the upside and now we're starting to make our way to the downside. Remember, the reversal is not the temporary one, right? The pullback is your temporary trend reversal. Your reversal is a full on, we're going in the opposite direction. We are no longer going in the direction of the original trend. We're taking on another trend. Where your pullback is what you see here. We were in a downtrend. Price pulled back, meaning it's starting to make its way back to the upside before it started to continue its original trend, which was to the downside. So if you said pullback for B, reversal for A, great job. You're picking up what I'm putting down. If you're not, go back and watch and see what parts you missing there. All right, I thank you guys for breaking bread with me. I'll see you guys in section 4. Welcome to section 4, where we're going to discuss major levels. Now, looking to the left of your charts, that's going to be where your crucial data is. That's going to help you in your trading decision because price has memory. So, since we know price has memory, and when we look to the left, we want to see if price returns back to this area, is it going to give the same reaction it gave last time, or is it going to give it different results? So when we're looking to the left, we want to identify not only those major levels, but we want to identify what trend we in. Are we in an uptrend or are we in a downtrend? Are we consolidating or are we in the range, right? All things that we went over so far, except for the major levels, and that's what we're going to discuss in today's section. So by looking to the left, we're identifying these major levels so we can make a decision about our entries, our exits, our targets, our stop losses, and we're going to call these levels support and resistance. Now, in this trading world, there's names for all of these levels, right? There's different names out there. Supply and demand, highs, lows, 50% opening ranges, closing rangings, right? It's called whatever you want to call it. Whatever you want to call it is fine with me, right? Whatever you want to call it is fine with me. It's going to be a level where the sellers are sitting at and a level where the buyers are sitting at, right? Whatever you want to call it, at the end of the day, that's what it's representing, right? But for the sake of this class, we're going to call it support and resistance. So, what is support? What is resistance? Support is the floor. Support is the bottom. Support is where buyers are stepping in and say, hey, I like this price. I want to buy it up. This is where buyers are stepping in and saying, nope, price don't need to go any lower. We got it from here, right? We like this price. We're going to buy it up. So support is the floor. Buyers stepped in. Price is bouncing off of this area, right? So if you look here, we see price um, got to this level, right? This line that was drawn here, and price is being bought up by the buyers. Buyers won't let it go any lower, right? It keeps pushing it back up above this line. So this is where buyers are stepping in at the levels of support and saying, we like this price. We're going to buy it up from here. You don't got to go any lower. This is a great price that we're willing to um, buy at, right? Now, your resistance, that's your ceiling, that's your roof, that's your seller's level. That's the area where sellers are saying price is too high. This needs to go back down. It's not letting price go any higher, right? So again, we got this level drawn out here, right? This line, and price is trying to go higher as the sellers are smacking that thing back down and saying, nope, nope, nah, too high. It's trying too high, right? It keeps rejecting off this level of resistance. So resistance is the top floor, right? Your ceiling, your roof, and that's where your sellers are sitting and telling you that price is too high. We need to go back then, right? Your support, your floor, that's your buyers. That's where buyers are saying, all right, we like this price right here. We're going to buy it up. And we're bouncing back up off this level of support. Now, to identify your levels of support and resistance is again, you have to look to the left to identify the major levels that you need to mark. Now, when marking these levels of support and resistance, you don't need to mark the whole chart. You don't need to mark the whole chart. But when you get to your time frame or whatever time frame that you want to use, you're going to come here and you're going to stand here and look to the left with your eyes, and you're just going to look to the left of the charts. And you want to look at the left of the chart and identify the area to where a price is getting the most hits, is getting the most bounces, the most rejects, right? Where a buyer is clearly stepping in at and where a seller is clearly stepping in at, right? So if I'm looking at line one, line two, and line three, and I just go through and I'm standing here to the left and I just want to look at it and I want to see the one that's getting that clear hit, right? Those wicks, right? The bodies is holding, but those wicks is giving me the action that I want to see, right? So if I'm looking at number one, I'll say, okay, well, this fell through, so it's not really strong there, right? Fell through here, not strong there. It doesn't get strong till back here. So we got one, two, three, four. We got some wicks right here. So we got about 6 hits here. So I would say this is a good area to mark, right? Now we go to this second area and we say, okay, good hit here, right? Got wick action here, bouncing up, right? So that's 3 hits, 4 hits, 5 hits, six, seven, eight. Line two is definitely a good area to mark, right? Now we go to line three, right? We go to line three. We got a hit here, one hit, two, three, four, five, six. You got 6 hits here. Now somebody would mark line three, and there's nothing wrong with you marking line three. But understand, sometimes when you mark all these lines, it's bringing confusion, right? It's going to be too much noise for you. So I would recommend if I'm looking at line two and line three, I'm looking for the area to where the bodies of the candles are being held. Whatever line I can see where the bodies is clearly being held, the wicks can do whatever they want. But if the lines is holding those bodies, that's the line I want. That's the line I want to mark. So if you look at three, yeah, it's getting wick action, but no bodies. No bodies. But if you look at two, we got body action here, price is holding above it. We got body action here, price is holding above it. You see this candle here push and the body's held above it. Same with these candles here. The body's pushed to this level. It even got to line three, but the body's held above it. So line two would definitely be one I mark. Line one, you can mark it as well because it does get body action here, right? It does get body action here. It is clearly holding, right? Only thing that would probably concern you is that, okay, it broke through here, but that's fine, right? That's fine. It could definitely break through there. So I would definitely 1 and 2 on my chart. Three, I don't need three. It's not, it's getting wick action, but no bodies, right? No bodies. All right, so let's look at resistance. The same thing. I'm going to stand here, look to the left, and we want to identify what levels we want to mark, right? So we got line one, line two, line three. Like I just told you guys, we're looking at support, the floor where buyers are sitting at. Same thing at the top where the sellers are sitting at. I don't want the line to where I just got wick, right? I have nothing but wick here. If I look all the way across, there's nothing here. Don't mark that level. You don't need to mark that level. If you want to, you can, but like I said, it's noise. So why do you need it? Like, why do you need it? There's no action really happening here, right? It's nothing here. It's nothing here. If I go look at line two, I do got wick action here. I do got wick action here and here, right? I wouldn't even mark line two. That's not where all the action is. If I had more body action here, I definitely would mark it. But line three, look at this, right? We get here, we reject. We get all the way up here and we still come back down. This is a strong level. This is letting us know, nah, the bodies is holding, right? The bodies is holding. This is letting me know price don't want to go higher right now, right? Price doesn't want to go higher. Price doesn't want to go higher. Price doesn't want to go higher. Price doesn't want to go higher, right? So when we come into the market and we look to the left and we want to identify these levels to where price has been previously, we want to see if it's going to give the same reaction it gave before, right? Before, when price got to this level, it got here, rejected, 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 right? And then started making its way back down. Now we're here again. We want to see if it's going to reject, 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 and start making its way back down. Is it going to hold strong like it did before, or is it finally going to break through and start heading to the upside, right? We can't hold this forever, right? We eventually are going to break through this level, right? Every hit is just making it weaker. It's just when it decides to go. When do buyers want to step in and say, all right, we good, let's go through it, right? So line three, for sure, leaving on my chart. One and two, it's up to you, up to you. But where those bodies are holding, that's where I want to mark. Now you want to look at these levels as zones, right? Not just a single line, because price doesn't react to an exact price. It's reacting to an area of interest for either buyers or sellers for the bodies, from the bodies to the wick. So think of it as an imaginary rectangle, right? So that thin line, just place an imaginary rectangle, or you can draw it out, and I'll show you guys in one of the sections how to do it. But you want to take it from the bodies to the wick, right? From the bodies to the wick, right? And look at it as a zone, because sometimes price won't even reach your level, right? Sometimes it won't reach your zone, right? But if you treat it as a whole zone, you can catch those bounces and rejects out of those zones, and you're not missing anything. So let's go back to the example that I gave earlier, to where I told you guys you want to do it from the bodies to the wicks. So if I'm looking at this level here, and I'm like, all right, well, the bodies is clearly holding here, then I want to draw an imaginary rectangle from the bodies to the lows of this wick when we're talking about support, right? So look at it as an imaginary zone. So then when price comes back into this area, we want to see if price is going to hold this zone and start making its way back out like it did last time, or is it finally going to break through, right? Even if you don't want to mark line one, let's say you wanted to mark line two, because this was line two, because this bodies was holding, you would do the same thing. You would just mark from these bodies, right, to these lows, and that will be your zone, right? That would be your zone. Let's look at the resistance side of things. The best line I said to mark was this line three here, right? So I'm going to go from the body area here, right, to the highest point of the wick, right? And this is going to be our imaginary rectangle. This is going to be our zone. And we want to see if price comes inside this zone, is it going to finally break through this time? Or is it going to do like it did before and just push in and then come on out of there? All right, we come to the end of this section. Thank you guys for breaking bread with me. I'll see you guys in section 5 where we put it all together. Welcome to section 5 where we're going to put everything that we talked about through section 1 through 4 all together in this section here. So let's talk about when not to take a trade. You don't want to take a trade when price is in the middle of the range, where it's choppy price action, where there's no clear direction if buyers are being in control or sellers being in control. We talked about that where we talked about price being in a range or consolidation, right? We don't want to trade that price action. Like we don't want to see price clearly choppy and then we want to look to take entry. That's not what we want to do. So we want to avoid that as best as possible, right? Sometimes you're going to find yourself in chop and not know it's chop until it's too late. But if we can clearly see it's chop on those charts, we should not be taking a trade. We don't want to trade in that area because that's where traders tend to overtrade. Overtrading just simply means that if you come into the day and say, okay, I'm only going to take 3 trades a day, But now you look up and you're on trade 5, 6, 7, 8, 9, 10, 11, right? We don't want to do that. We want to stick to how many trades that we say we're going to take a day, right? And we got to stick to those rules. And we also don't want to ignore structure. If you're ignoring structure, then you should not be taking a trade. You want to look who's in control, what's the trend on a higher time frame, higher highs, higher lows, lower highs, price respecting area, breaking areas. We want to see that information. If you're not paying attention to that information, then you should not be looking to take a trade. You also want to make sure you're going with the flow of the higher time frame. The higher time frame sets the direction. Your job is to align with price, not argue with it. We don't fight it. We can't make price do anything that we want to do. All we can do is wait for price to do what fits into our strategy and into our plan. And once it does that, we'll look to execute. But don't think that you can control price. We don't have mind control over price, right? We just got to play price and take it for what it is. If the higher time frame is bullish, meaning its price is heading to the upside, you should be looking for longs. You should be pushing that green button. If the higher time frame is saying bearish, heading to the downside, then you should be looking for shorts. You should be pushing that red button, right? The higher time frame goals matters more than the lower time frame. The higher time frame goals matter more than the higher time frame. Understand, price is not moving just to move. Buyers have a goal that is trying to accomplish, and sellers have a goal that is trying to accomplish. Right? So that's why we have to use those higher time frames to identify those major levels, and we want to see what price does when it gets to those major levels that we have marked out. Excuse me. Also, don't fight structure. We're going to follow it. We got to flow. We got to flow. Can you be profitable not going with the flow? You definitely can. But why would you want to work that hard? You shouldn't want to work hard at trading. Like this should just be easy. You should just flow with price, which is what the higher time frame is saying, and just let that flow, right? We don't want to work hard. We don't want to fight this. We just want to flow with it. We just want to flow with it. So use the higher time frames to identify your trends, your range, and your key levels. You're going to let the lower time frame help you with your timing to identify when you should enter your trades. You want to use those pullbacks that we talked about, those temporary trend changes. Those are going to be your opportunities, or your best opportunities to look for entries. When price is respecting, meaning it's pushing past, leaving that wick behind, right? But it's not closing beyond the level on the higher time frame, then you have to trust that level. That's letting you know that that is a strong area. That's letting you know that it's either truly buyers here or it's truly sellers here. If the higher time frame breaks, meaning it's closing beyond the level, then we got to be flexible in our bias and we have to reassess price action. Now, for me, the time frames that I like to trade with is the 4 hour with the 15. So the 4 hour is my higher time frame, the 15 is my lower time frame. Or the 1 hour and the 5 minute, right? Along your trading journey, you're going to have to identify what time frames you like to trade on, right? Some can stay on the lower time frame all day. Some can just stay on the higher time frames all day. It's totally up to you and what you're trying to accomplish along your trading journey. Whatever time frame you choose, whatever time frame that fits you and your lifestyle and what you're trying to accomplish, you want to make sure that you have confluence. Now, confluence is when you have multiple signals, indicators, or price factors all aligned to support the same trading idea or direction. The more things that you have in agreement, the stronger your setup becomes, right? So if I use the 1 hour and I use the 5 minute, those both things have to stay in the same direction for me to take the trade. If they're not, if one of those is off, then I don't have to trade. So you want to make sure they're all on the same page. Again, we go with the flow. We should all just flow. It shouldn't be a fight. It's a fight if I want to take a trade and the 5 minute is saying to the downside, but the 1 hour is saying to the upside. That's going to be a fight. I want to flow. Let it all go in the same direction, and then I'm going to look to get into my trade. Now, let's talk about a strategy. Right now, there's so many strategies out there. I'm sure you guys have seen it. If you're not, great. But there's so many strategies out there. But I want to leave you guys with a strategy, just to set you guys up, right? For me, along my trading journey, I probably had at least 4 or 5 strategies. I went through 4 or 5 strategies before I found the one that fit me and how I currently trade today. Now, I'm going to set you guys up with a strategy that I wish I learned when I first started trading, at least the first strategy that I wish I had when I first started trading, and that's the break and retest. Real simple. Real simple. So price breaks through a level, then it comes back, meaning it pulls back to test that area before continuing in the direction that it broke. So we need to see price break through a level that tells us who's in control, right? We need price to pull back a temporary trend change to give us confirmation. We need it to hold that level, meaning it's not closing beyond that level. It can push all day, but we don't want to see it close beyond that level. If we can see the break and the hold on the retest, then that should give us confirmation that that level is strong and price should continue back in the direction that was broken. So if buyers broke the levels, we should continue heading to the upside. If sellers broke the level, then we should continue heading to the downside. Now, when price break and it comes back to that level and it fails on retest, meaning that it's not holding the level, meaning it's closing beyond the level, that's letting us know that that level is not as strong as we think, right? It's a little weak, right? So we just want to pay attention to it. But we're looking for the break and retest. We're looking for price to break that level, come back and retest that level, hold, meaning it's going to leave a wick behind, right? Hold that level. It's not closing beyond it. And we're going to look for price to continue back in the direction that it broke. So what could that look like? That could look like something here. So we see that we're in a downtrend, right? We got highs, we got lows, we got lower highs, we got lower lows, we got lower highs, we got lower lows, right? So we're clearly in a downtrend. But we see that price has created a range here, right? Let's see if I can draw it out. So that green line is going to be somewhat the bottom side of that range. And we're just going to mark the top side of this range here. Just want the bodies. I don't really care about the wicks when I'm looking for the range, right? So top side of the range, this bottom side of the range here, right? Where price is clearly coming, but buyers is saying nope, and it's bouncing price back up, right? Where sellers is saying nope and sending price back to the downside, right? So price is rejecting off resistance and is bouncing off support. So we have a clear sideways action here, right? Until price finally breaks through. Like I told you guys, the levels are only getting weaker. It's going to eventually break through the level, right? It's eventually going to break through the level. So when we can see price break through a level to where price was clearly holding before, and now we're breaking through, meaning we're closing beyond this level, right? So this is the level we close on the downtrend candle at the bottom of the body, right? Now we want to wait for price to return back to this range, and we want to see if price will hold this area. So we can see that price came back to this area. This is the retest, right? It gave us this long wick, and then it started making its way back down. This is letting us know that this is a strong area. Sellers are for sure here, and we should continue in the direction that we broke out of. So we broke to the downside. We're coming back to retest this area, and we're heading to the downside. And if we continue reading price action, what is this? A lower high, right? Like I told you guys in the pullback section, we have to pull back. We have to correct. We have to go put in that lower high before we go put in the new lows, right? So when we see that, that gives us confluence. All right, cool. I got price pulling back to a level that it once broke. Now it's retesting that area. It's holding that, right? That's confluence. It's putting in a lower high. That's confluence, right? So now we're just building our story to why we should be looking to get in this trade to continue heading back to the downside. And we know at minimum, we should be going to put in a new low, right? So all of these lows right here are all these lows that price should break through if we're going to go put in a new low, right? That's how we get a lower low, right? And that's what this candle did here. But it broke it here with this candle, but I made it official here within this image, right? So that's the confirmation that we should continue heading to the downside. When we can break a level that we were struggling with before, right? This is to the upside or to the downside. But we break a level that we were struggling before and we come back and retest that area, right? It pushed above, but it held that area. We should continue heading to the downside. And that's enough confluence for us to take a trade. Now, what does a failed attempt could look like? A failed attempt could possibly look like this. So we have price in a range. Well, let's look at it. We're in a downtrend. It's looking like we're in a downtrend, right? Then price pulls back and we create this range. We're ranging. We got the buyer sitting here. It's not letting price go any lower, right? We got the seller sitting here. It's rejecting price. It's not letting price go any higher, right? Until we finally break through, right? We finally break through. All right, most people might take this and be like, oh, we break it through, we're going to continue going to the higher. No, what I'm asking you guys to do is to be patient and let price return back to this area. And as you can see, price returned back to this area and it just fell through. So this is telling us they was just playing. Buyers ain't there. They are not there. It broke through like, yeah, all right. But no, they're not there. They're not there. So this is where I talked about reassessing, right? Because this is a break, but it's not holding. It's failing to hold. So this can't be a break and retest because that's not what it did, right? It broke and retest and failed, but it didn't break, retest, and hold this area, right? It has to hold this area. So we can't take this trade. We got to reassess and we got to find out what price is trying to do now, right? What price is trying to do now. So that's a failed attempt, no confirmation. So now let's look at this. I told you guys I used the 60 and the 5 minute, right? So if I'm looking at that 1 hour, right, and I'm seeing prices clearly playing between the range, that's the top line and the downside area here. Now price finally breaks through the top side of this range. It finally breaks through, right? Now I need to wait for price to come back and retest this range and confirm to me that this is a strong area. If it holds, which it's doing here, if it holds, then it's letting me know that we should continue heading to the upside. So once I see this break on the 60-minute and I have this level already drawn out, I don't gotta do anything else, right? I could drop down to the 5 minute and see when price returns to this area, will it hold this area, right? I want to see it hold this area. So fast forward and I can see this candle here, let me mark it. This wick and everything that's going on here is these candles here, right? Until we started making our way back up, right? So this is all wick. So when I come down to the 5 minute and I see, okay, well, price dipped inside this area here, right? We dipped inside this area here and then started making its way back out. So this could possibly be a break and retest. Now, when I tell you guys to not ignore structure, this is what I mean. And this is how we build confluence. Because not only are we getting a break and retest on this higher time frame, if we look at the lower time frame, price ranged here, right? It created a little range here. So you can see price came inside this range and started making its way back out of this range, right? It can play inside the range all day, right? What we don't want it to do is close below the range. If price closes below the range, then we have a problem, right? So yes, it closed below the range on the 1 hour, but it's still respecting the 5 minute range here. So keep that in mind. The lower time frames is just setting you up for your wicks. This is how you can see that wick form. But you want to see the hour respect the hour levels. You want to see the 4 hour respect the 4 hour levels, right? So it has an hour in time to respect this level. It has 4 hours in time if this was the 4 hour to respect the level. It has 15 minutes if you want to use that as your higher time frame. If this was a 15-minute charts, it has 15 minutes to respect this area. But that's how we build confluence. I have a break and retest on the 5 minute. I have a possible break and retest on the hour time frame. So now we want to see. And once I can get confirmation that we are breaking and retesting, how do I do that? Well, I just restructure. I got a break and retest here, but not only do I have that, I have a low, higher low, right? I have another higher low. So if we are to continue heading to the upside, which this side broke out of, then our highs, I mean our lows would get higher, right? That's what price is supposed to do if we're heading to the upside, right? That's what we're supposed to do, right? And that's what price did. So when I build that type of confluence, I'm going to look to take entry, and I understand that I can take entry and play it to whatever targets that I have on my higher time frame. So when I take it to the charts, I'm going to show you guys how to do that. But we can't stop reading price action. We can't stop reading market structure, right? If we are to continue heading to the downside, our highs wouldn't be getting lower, our lows would be getting lower, right? And that's not what we're doing. We're making higher lows. All right, so let's take it to the charts and let's put it all together. Let's put it all together. All right, so here we have here we're going to be looking at NQ. Let's go to our higher time frame, which is the hour. And when we come in on the day, like I said, you want to identify any major levels and you want to make sure it's relevant to where price is currently. So if I'm looking to draw levels of support and resistance, I want to look for areas to where price had returned before and gave a great reaction afterwards, right? So where it clearly looked like it ran into a wall and it went the opposite direction. Those are the levels that I want to mark. So the easy ones is the top, right? We got here rejected, got here rejected, and then the bottoms, right? So we can come in and mark this level if we wanted to. We can come in and mark this level if we wanted to, this level if we want to, right? These bodies that's being held, bodies being held, right? We're getting clear reaction from the bodies there, same back here in the past, but price is currently here, right? Price is currently here. So we need to mark a level here. So if we look here, if we look across, we can clearly see that this is a strong area before. Let me draw the line so y'all can see it. Right? So we can clearly see we got action from this level before. So I know if price can close above this area based off the hour, we should head to this target here. But remember the rectangle that I talked about, right? And this is trading view. This is trading view that I'm using. So if I would have came in here and drew a rectangle, right, from the highs of the bodies to the lows, right? I will not the highs of the body, but if I take it from the bodies to the lows, that would be my rectangle. If I came up here to the top and I wanted to draw a rectangle, I would go from the bodies to the highs, right? This is the bodies that's being held, and this is the high that price has gotten. Even with this one coming in here and sticking in, right? It's still this body into these highs there. So if I can catch price coming out of this area based off the hour time frame, our first target would be here. Our next target would be that area above. Now, can you come in and say, okay, well, I can mark these bodies here, and then I could come in and then mark these here, right? And then I'll come in and mark. You could definitely do that, guys. There's no right or wrong to it, right? It just depends on if maybe that's too much noise for you. Then no, you don't want all those lines on your chart, right? But if that's not too much noise for you and you want to take it step by step, if I can see price close above this, then next target. If I can see price close above this, then next target, and so forth, you could definitely do that based off the higher time frame. So it's got to be based off the higher time frame. So if we look at the higher time frame right now, Let's identify the trend. So we are in a uptrend, right? This is looking like a temporary pullback. Why do I say it's a temporary pullback? Because prices pulled back, right? And it started to make its way back to the upside. So if the trend is here, this is looking like what? A lower high, right? Oh, a higher low, let me say that. A higher low, right? That's what that's looking like. All right, then we got price ranging, and then it did a crazy drop. But what is that? Again, a higher low, right? And then we started making our way back up to the upside. Now we got up here to this upside. We did not put in a higher high, right? This high, let me zoom in for you guys. This high did not take out the highs here, right? So this is actually a lower high. So price dropped. But what did it do? It put in a higher low, right? So it still hasn't invalidated this uptrend, right? Now, the moment it invalidates this uptrend, what would price have to do? I know we didn't talk about it. It's kind of advanced, but I'm gonna say it. Has to go put in a lower low. The moment price goes puts in a lower low, then we have something to talk about. But until that happens, buyers got it. Buyers are in control. Until sellers can prove that it's on them, meaning that they're putting in lower lows, until that happens on this higher time frame, then none of that other stuff matters, right? So let's see if we can take action on price here. So we got the levels marked. We got price coming off a higher time frame area here, right? This zone that I just put the imaginary rectangle around, right? So now we want to go see, are we going to go put in a higher high, a higher low based off price action on the hour time frame. So we're going to move this forward. It's a nice little replay feature on TradingView if you're not familiar with it. But I'm gonna move it forward to right before market opens, and I want to see what price it's looking like. But everything is saying to the upside, so we just want to build that confluence. But what we're gonna look for is a break and retest. So if I can get price to break above this area, let me go take those levels off because I wouldn't have those on my chart. If I can get price to break above this area, take that one off too. If I can get price to break above this area and come back and retest this level, then I will look to take entry based off the strategy I just taught you guys. Now you could be on any time frame to see this, right? You don't gotta just be on the one. I recommend you guys having multiple charts up and watching multiple time frames at a given time. But we're gonna run this for it. Let's see what price does. All right, so we see that price broke above this higher time frame levels, but we can't do anything until price comes back and respect this area. Now, it could come back down here if it wants to, or on this 5-minute time frame, it can create a range, break through, come back and retest it, and then we'll look to take entry there. So let's see what price does. All right, so now if we look at this on a 5-minute time frame, this is how we build confluence. We got the hour breaking through, right? We got the hour breaking through saying to the upside. Right, now we got price created a range here, right? It created a range. That's the top side of the range, that's the bottom side of the range. So just these candles here. Now we got price breaking through this range. Now I need price to return back to this range, hold, and then I'm going to look to take entry. That's it. Simple, right? Price broke through, right? This is the range. Price broke through. Now I'm waiting. I'm being patient, and I'm letting price come back and retest this area and hold. If it can retest and hold, that gives us confluence with what the hour is saying because the hour already broke through. Right? Price said, nope, we're not coming back to retest this one. So I got to take the information on this lower time frame and build confluence with what the higher time frame is saying. So I identified the range. I let it set up the range. It broke out of the range. It came back and retested this area and it started to make its way back out. So the moment I see this, I have to touch that green button to get into my trades. Our ultimate goal is to get to this hour level here. All right, well, let's say we missed that one. All right, cool. If you look here, price created another range. It has that high, it has these lows. This is a range, right? It's breaking, it broke. This was a range, it broke through. Okay, now it created another one, right? Now we got these highs and these lows. Went to these highs, seller stepped in, said nope, dropped it down, buyer stepped in, said great price. Now we're starting to break out of this range. Same thing. I need price to break out of the range, come back and retest this range and hold. If it can retest and hold, we're going to look to take entry back to the upside, right? This time it came all the way back to the bottom side of the range. It still never broke below the bottom side of this range, right? This is the top side of the range. This is the bottom side of the range. So you're treating this whole thing like a zone. So the same thing we did with the imaginary rectangle here, it's the same thing you're doing with these ranges that's being created. As long as price holds this range, we are good to continue heading to the upside, right? That's what we're looking for. That's simple. And let's just say hypothetically, I don't know if you guys are thinking this, but let's just say hypothetically, you look at this and be like, well, it broke to the downside. It did, but remember we talked about breaking and failing with confirmation and breaking and giving us confirmation. Yes, this broke, but then price would have to come back up here, retest and hold, and then continue heading to the downside. It never did that. That's advanced thinking. I know we're basic, we're keeping it beginner. I'm sorry, I apologize. But when we see that, that should give us confidence. Okay, Lana, that's not what they was trying to do. Sellers aren't truly there, right? When we couldn't hold this, but come back to the upside, it's not truly there. But remember, I said go with the flow of the higher time frames. We shouldn't be looking for nothing to the downside until the hour gets here. The hour said the next level that we have to get to is here, right? That's the next level we have to get to. And then if we can get a close above that on the hour time frame, the next level we got to get to is here, right? And that's it. And that's pretty much it. Like there's nothing more to the strategy. There's nothing more difficult to it. We play it to the target. And if price want to continue, then price continue. If it doesn't, then it's time to exit your trades. But that's simple. Break and retest. That's how you mark your levels. Let's go find another day and let's mark some levels on another day. Just so I can make sure you guys are really set up, right? On the hour time frame. Let's take it back. Let's take it back on let's just say we came in with price on this day. All right, so if I come in and I look at price, this is where price is currently at. Remember, we're looking from price to left to right, right? We're looking at price from left to right. I am on the 1 hour time frame. If I'm looking at price left to right, I want to identify my levels of support and resistance. So I'm gonna come in, like I said, the bottoms and tops are the easy ones. Mark these bottoms, right? I mark a top, right? Like I said, you want to come in like, well, I can put a level here and maybe I could put a level here. Great. Whatever you want to do, if that works for you, and that's not too much noise for you, more power to you, right? More power to you. But you're looking for these bodies where the bodies is clearly holding, but price is pushing past. Bodies is clearly holding, but price is pushing past, right? We got hit, 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 right? Same thing at the bottom. Bodies are holding, right? Price is bouncing, right? Um, and that's those are the levels that you want to mark. So if I see price returning back to this area, I want to see if it's going to give the same reaction that it gave previously. So the same thing here. Price get back to this area. I want to see if it's going to give the same reaction that it gave before, which it dropped to the downside. So that's the whole point of marking these levels. And let's see what price did. Let's see if it give the same reaction it gave last time. Right, so we can see at open, at market open, it did give the same reaction it gave last time. It was just short-lived, right? because now it went to these levels of support that you guys marked and started making its way back up to the upside, right? So it gave the same reaction it gave at the top, the same reaction it gave before at the bottom. So that's the importance of marking these major levels, the importance of it, right? But again, the higher time frame is saying to the upside, we shouldn't be pushing this button to the downside, right? We should only be pushing this button to the upside until the higher time frames says otherwise. And when is that? Then that's when market structure starts to shift. If we're heading to the upside, our low shouldn't be lower. If we're heading to the downside, our high shouldn't be getting higher, right? That's how we read market structure, and that's how we can identify those trend reversal. Again, Advance, I know, I'm sorry, I apologize. I apologize. But yeah, hopefully this makes sense. I hope this makes sense to you guys. Let's take it back to the class. All right, so the most important part of trading is your mindset. This is going to be the hardest things for you as a trader. The charts, analysis, that's the most easiest part of trading. The most difficult part of trading is your mindset, and this is the most important piece of trading because trading is a you versus you system, right? You got to identify what you needs to show up for you to be profitable in trading. And just like I told you guys that price has to align, so does your mindset. So your discipline, your patience, and your emotional control, right? So your discipline, this is you creating your rules and your plan, then doing exactly what you said you would do, even when you don't feel like doing it. So if you say you're only going to take 3 trades a day, then you can only take 3 trades a day. If you say you're only going to take this particular setup or this particular strategy, then you have to stick to that. You can't go outside those lines. And patience. This is where waiting for price to come to you instead of you chasing it. Like I showed you guys with the break and retest. You can't chase price. Let it come back. It's going to come back. Pullbacks happen, right? Pullbacks are happening every day in the market on every time frame. Let it come back. Let it respect that area based off the strategy that I taught you guys. Now, anything outside of that, that's on you guys. But let it break. Let it come back and retest. Let it hold. If it holds, you should be looking to get in your trade and play in the direction of the higher time frame. If it's not in the direction of the higher time frame, don't even put yourself through that, right? And then emotional control. This is staying neutral, win or losses. There's no revenge trading. Revenge trading is when you take a L and now you feel like you got to get your money back. And now you start over trading, right? We talked about over trading. That's an example of revenge trading. No FOMO, fear of missing out, right? Just because price is running or somebody's getting into a trade, you feel like you gotta get in. No, we're gonna stick to our rules. We're gonna remain disciplined. And no fear. Don't be scared, right? This is where you gotta back test and prove that the strategy that you're trying to set up for yourself works. That's how you remove that fear. But you can't be scared to lose and you can't be scared to win. You just gotta get into your trade and trust that the work that you're putting in is going to pay off, right? You're going to execute the plan and let the outcome be the outcome. We have no control of the outcome, but all we can do is put a plan in place that works for our sales, works for our personality and what we're trying to accomplish. And all we can do is hit that button and execute. Understand patience is going to keep you out of your bad trades. Discipline is going to get you into your right ones. And that emotional control is going to help you respond instead of reacting. When you find yourself being emotional about trading, or you're angry because you lost, or you're happy because you won, you got to be neutral on both sides. Don't show any type of emotion. And it's hard, right? It's definitely going to be hard because they're human beings and we're emotional beings. But it's understanding when you're trading out of emotion or trading in emotion. You never want to trade out of emotion. You don't want to let your emotions to be in control. You never want to let your emotions be in control. Oh, I'm angry. I lost. I must go get that back. That's emotion, right? That's not what you want to do. And that's going to happen. It's going to happen, right? It's going to happen. But you got to be able to identify it and make the needed um, adjustment. So when your mindset aligns with your strategy, then you are fully aligned. Oftentimes, as traders, we feel like we need to be profitable every trade and we need to be consistently profitable every trade. No, you just need to show up consistently every day mentally and align your strategy with price, and you will be okay. We have come to the end of this beginner's class. I thank you guys for joining me. I thank you guys for putting in the effort. I hope this information was informative to you guys. I pray that it bless you along your journey. But until next time, I thank you guys for breaking bread with me. You guys have a blessed one.